In today's fast-paced financial world, the strength of any company depends on how responsibly it manages its obligations. Growth is not just about earning more, but about maintaining balance between what a company owns and what it owes. Among the most important indicators of a company's financial health is its level of debt, a reflection of how much responsibility it carries and how wisely it handles it. Company debt represents borrowed funds that must eventually be repaid. Many businesses rely on it to expand operations, develop new products, or stabilize cash flow during challenging times. When used properly, debt can be a strategic tool for development, but when misused, it can become the very reason for collapse. Understanding the line between the two is vital for every investor who values integrity, sustainability, and long-term success. A responsible company borrows only when necessary and within limits that it can realistically manage. It maintains transparency about its liabilities and ensures that repayment is planned through legitimate and productive income sources. Such companies use borrowing to build something real: factories, services, technology that benefits people and generates genuine value. In contrast, some organizations treat borrowing as a shortcut to artificial growth. They rely heavily on loans to create the illusion of expansion, even when the underlying business remains weak. This practice is unsustainable and often leads to instability. The short-term satisfaction of rapid growth eventually turns into long-term pressure, as increasing obligations start consuming profits and reducing flexibility. For investors, the first red flag is imbalance. When a company's debt grows faster than its earnings, it signals a deeper structural issue. It means the business is living beyond its means. Such imbalance forces management to make compromises, cutting jobs, lowering quality, or reducing ethical standards to survive. These actions may save short-term profits, but damage long-term reputation and stability. Financial discipline is a sign of moral strength. A company that respects its limits and keeps its promises earns the trust of everyone around it: employees, partners, and customers alike. On the other hand, when borrowing becomes reckless or hidden, it erodes confidence. Transparency, honesty, and accountability are not just moral values, they are the foundation of a stable economy. Investors must also look beyond numbers. A company's financial statements can appear impressive, yet its underlying structure may be fragile. Heavy borrowing often hides beneath the surface of glossy reports. It's easy to be attracted by growth figures and quarterly gains, but real analysis requires deeper understanding. Investors should ask, is this company creating genuine value through production and service? Or is it simply moving borrowed money from one place to another? Healthy borrowing is tied to productivity. When a company takes on obligations to create tangible assets, provide employment, or support innovation, the debt becomes purposeful. It contributes to both the company's progress and society's benefit. However, when borrowing is used only to sustain appearances or fund unproductive ventures, it creates instability. The concept of real value should always guide financial decisions. Real value comes from genuine work, creating goods, providing services, supporting people, and generating fair opportunities. Debt disconnected from real activity becomes hollow, leading to volatility and mistrust. Companies built on authentic value grow steadily and stand strong during economic shifts. Those that rely on borrowed foundations often crumble when market conditions change. Another key aspect is intention and responsibility. Borrowing is not just a financial transaction, it's a promise. When a company commits to repayment, it also commits to reliability and accountability. Breaking that trust harms not only business relations, but the overall spirit of fairness in the marketplace. The best organizations are those that honor their word, even when it costs them effort and sacrifice. Investors who value ethical conduct should always examine how a company treats its obligations. Does it respect its commitments? Does it disclose its liabilities clearly? Does it maintain fairness in its operations? A business that upholds such values is safer and more dependable in the long run than one that merely chases fast profits. A balanced financial model encourages moderation, growth without greed, expansion without exploitation. This mindset prevents excess and keeps companies grounded in reality. Moderation ensures that businesses expand at a pace supported by their genuine capabilities, not by borrowed illusions. The world has seen many examples of corporations that rose rapidly through over-borrowing, only to collapse under their own weight. Each story teaches a lesson. True success is built on discipline, not debt. Investors who recognize this pattern early protect themselves and others from unnecessary harm. Financial responsibility also has a social dimension. When companies borrow excessively and fail, they don't fall alone. Their collapse affects employees, suppliers, and communities. That's why responsible borrowing is not only a business decision, but also a social duty. A stable enterprise contributes to economic harmony and collective trust. Long-term prosperity depends on integrity. When financial decisions are made with conscience, they lead to lasting results. Companies that grow through genuine effort rather than manipulation serve as examples of how business and ethics can coexist. Such organizations bring stability, inspire confidence, and create environments where everyone benefits. The most sustainable businesses are those that remain grounded, transparent, and mindful of the impact their choices have on others. They avoid unnecessary risk and prefer steady, meaningful progress over fast but fragile expansion. This balance ensures growth that benefits both the company and society as a whole. In conclusion, company debt is not inherently negative. It becomes a problem only when used irresponsibly or without purpose. The key lies in discipline, honesty, and real value creation. When borrowing aligns with these principles, it supports growth and progress. But when driven by greed or carelessness, it turns into a red flag, a signal of imbalance and instability. For thoughtful investors, recognizing these signs early is essential. The goal is not to avoid debt entirely, but to understand its purpose and limits. A company that borrows wisely, creates value, and honors its responsibilities deserves trust. One that neglects these fundamentals invites risk. True financial success is achieved not through speed, but through sincerity. Not by how much a company earns, but by how honorably it earns it. That principle remains timeless, guiding every responsible investor towards stability, balance, and lasting prosperity. In the complex landscape of global finance, understanding how companies handle debt is one of the most important aspects of evaluating long-term stability. Investors often focus on innovation, revenue, and expansion, but the unseen weight of debt can quietly decide the future of any business. Debt management is not just a financial tool, it's a reflection of a company's character, discipline, and vision. A firm built on ethical responsibility and measured growth always stands stronger than one driven purely by ambition and risk. A company that practices restraint in borrowing understands that every obligation carries moral and operational consequences. Borrowed money can accelerate progress, but it also tightens accountability. When a business borrows within its capacity and maintains clear repayment plans, it nurtures confidence among investors and employees alike. In contrast, a company that uses debt carelessly loses both trust and control. This difference defines whether an organization grows sustainably or collapses under financial pressure. One of the most telling signs of a company's financial maturity is how it prioritizes responsibility over reward. Short-term success achieved through excessive borrowing is like building on unstable ground. It may look impressive, but it lacks endurance. Real financial wisdom lies in patience, not in taking shortcuts. When businesses invest their borrowed funds into productive ventures that generate real value, they strengthen both their reputation and the broader economy. But when borrowing serves only to mask weaknesses or inflate figures, it becomes a dangerous signal. Investors should pay close attention to the purpose behind a company's debt. Is the borrowed capital used to create tangible progress, new products, job opportunities, or technological innovation? Or is it used to maintain appearances, pay old loans, or project temporary growth? Responsible borrowing always has a clear, measurable goal that leads to genuine improvement. Unclear or repetitive borrowing cycles suggest instability and poor management. Another key factor is transparency. A trustworthy company discloses its obligations openly and communicates honestly with stakeholders. Concealing liabilities Manipulating reports or presenting incomplete information is a major warning sign. Ethical companies, on the other hand, earn investor confidence by being forthright about their challenges as well as their strengths. This culture of openness sets the foundation for long-term cooperation and stability. In a competitive marketplace, debt can also shape how a company treats its employees and customers. When pressure from obligations grows too heavy, management often looks for ways to cut costs, sometimes at the expense of people and quality. Such behavior might preserve profit temporarily, but erodes the company's moral foundation. Ethical leadership understands that a business's greatest asset is its people, not just its financial numbers. Protecting fairness and well-being during tough times strengthens the company's long-term credibility. A stable company views debt as a responsibility, not a privilege. Every borrowed amount must be matched with purpose, accountability, and the ability to repay through legitimate operations. Businesses that forget this principle end up enslaved by their own liabilities. The path to resilience lies in self-control, knowing when to expand and when to pause. Growth must never come at the cost of stability. Investors should develop the habit of reading financial reports with a critical eye. Instead of focusing solely on profits, they should analyze cash flow, asset quality, and the ratio of debt to equity. These indicators reveal the company's internal health far more accurately than surface-level success stories. A business with consistent profits but growing liabilities might already be walking toward danger. Understanding these patterns helps investors protect both their capital and their conscience. One of the most powerful traits of a responsible company is adaptability. Economic conditions change, markets rise and fall. When a company has moderate debt and flexible planning, it can adjust strategies without falling apart. But when liabilities are too high, even minor market changes can create crises. The ability to remain steady under pressure comes from financial discipline and balanced decision-making. Every great business leader knows that reputation is more valuable than numbers. The way a company manages its obligations reflects its integrity. Those who prioritize fairness over speed and truth over image eventually earn the loyalty of partners, clients, and investors. A good reputation cannot be bought. It is built over years through honest effort, transparency, and consistency. Responsible borrowing also supports social and economic well-being. When companies maintain financial stability, they create jobs, pay suppliers on time, and contribute to the broader community. Their success becomes shared success. But when corporations collapse under heavy loans, they cause chain reactions, layoffs, unpaid dues, and loss of trust in the system. Stability, therefore, is not just beneficial to investors but to society as a whole. Sustainability is the ultimate goal of modern finance. It means creating growth that can be maintained over time, without harm to people or institutions. A debt-free company may be rare, but a well-balanced one is realistic. It's not about avoiding borrowing altogether, but about managing it with maturity and foresight. Companies that set realistic goals, maintain reserves, and focus on organic growth demonstrate this sustainable mindset for investors. This means adopting a disciplined approach as well. Investing should never be based on emotion. Careful study, patience, and ethical judgment produce better results than impulsive decisions. The most successful investors are those who look for value, not trends, who prefer solid foundations over risky promises. They understand that genuine success is built through honesty, not exaggeration. The story of every financial crisis teaches the same lesson: unchecked borrowing leads to downfall. The global economy has witnessed corporations and even nations crumble because of uncontrolled debt. What starts as ambition often turns into obligation, and what begins as opportunity sometimes becomes burden. These examples remind every investor to remain cautious, informed, and morally centered in their financial choices. In the long run, the companies that survive and thrive are those that keep promises, honor their commitments, and stay grounded in principles of fairness and restraint. They borrow wisely, spend thoughtfully, and build patiently. Their progress is steady, their foundation strong, and their future secure. Investors who align themselves with such organizations not only gain profit, but also peace of mind. Ultimately, The measure of a company's success is not how much it borrows, but how much it contributes through innovation, honesty, and positive impact. Real progress is never achieved through shortcuts. It grows from dedication, trust, and responsibility. Debt used with care can empower. Debt used carelessly can destroy. For every investor seeking stability and meaning in financial growth, the message is simple. Choose companies that value integrity over image, responsibility over recklessness, and balance over ambition. These are the businesses that shape strong economies, uplift people, and stand firm through every challenge. True prosperity is not about having more, it's about earning through fairness, managing with conscience, and growing with purpose. That is the essence of responsible finance and the foundation of a stable, lasting future.